How about now?
Okay, we see it.
See it?
Perfect.
Yeah.
All right.
Thanks for
Let's
rolling with it, everyone.
go.
All right, let's
I
go.
love this startup. It's one of my favorites.
Three.
Thank you.
Perrin, you got 3 minutes. 3, 2, go.
Awesome. Hi, everyone. I'm Perrin, founder of EATERCLUB. We're disrupting a $320 billion legacy food service industry by offering a curated distributor to save next generation restaurants time and money. The U.S. food service facilities market's extremely large, well over 1 million plus food service facilities, and they're fragmented as well, with 70% being single unit operators and extremely difficult to reach. Collectively, they're spending over $320 billion annually to stock their restaurants. I'm going to break down a big industry problem, how EATERCLUB's best positioned to solve it, and how we're on our path to becoming a billion-dollar business. The industry issue is that restaurants can't easily source the best vendors, and vendors can't find the best restaurants. So it's our job to help save them both time and money and cut through the noise. How do we do it? Well, EATERCLUB's a marketplace curating the world's best products to the world's best restaurants. Let me break down our approach. First is Story as the new salesperson, where we create original business and consumer content to bring all of our products to life as more than photos or text on a page and cut out any middleman between our buyer and the restaurant. We pair that with sampling as a service, where we offer amazing products like Fresh Fizz, Daily Crunch, and other great brands, and we curate them directly to stakeholders, letting them try before they buy. And ultimately, we have a curated warehouse that makes it easy to both discover amazing products and also make a purchase. But that's not all. 90% of customers will experience a restaurant online in some capacity before ever dining there. So EATERCLUB has to help our buyers meet the customers where they are. How do we do it? We give buyers turnkey content directly into their inbox, making it super easy to tell these amazing product stories in their online and social channels. And that way they can get customers excited to come in and experience these amazing products firsthand. And since everything on the platform's curated, we know there's going to be a great chance they love what they try. And you also might want to know how EATERCLUB's best positioned to solve this. Well, it's content, community, and editorial. That's exactly how we've cracked the two-sided marketplace. On the content side, LA Eats is our in-house content studio, producing premium content using lean production processes with no budget, including amazing coverage like Wolfgang Puck at the Oscars.
Okay, all my friends at LA Eats.
We've also developed an amazing restaurant community through that editorial coverage with over 800 plus restaurants and growing. And it's that editorial coverage that's at the core of our restaurant vendor discovery engine. LA Eats powers a natural way for us to grow both sides of the marketplace organically, while naturally growing our audience in the process. We have 10 vendors on the warehouse as of today with over 30 SKUs, and we have 300 plus vendors in our editorial pipeline at different stages of evaluation. Vendors pay $1,499 to join, plus a 15% sales commission across the platform, and there's a monthly fee between $89 and $299 a month. And restaurants will be paying a small monthly fee in late 2024. We have a clear path to $10 and $100 million in revenue from the marketplace alone. It breaks down into about 3,500 restaurants spending about $531 a week by 2025. That helps us get to over $57 million in annual revenue. We have a team uniquely positioned to bring it to fruition with their operational, creative, and community curation background, including my background creating a reality show for Bon Appetit magazine. We're EATERCLUB, a curated distributor saving next-generation restaurants time and money.
All right, well done, Perrin.
Well done.
I'm going to take some questions from our investor guest judges and syndicate members. Please feel free to drop them into the Q&A box and just go ahead and tag the name of the founder or the startup whose question that is. So I'm going to start with Amit. Question for Perrin.
Yeah, great job with the presentation.
Thank you.
Maybe 2 questions from my side. One is, as you think about like the cost of doing this versus their traditional cost, can you highlight like kind of what they're saving or how much additional they're spending? And then second, how do you think about like folks, once they establish the relationship with the restaurant, like kind of circumventing the platform and not wanting to pay a percent of every transaction they're doing with that restaurant?
All right, terrific. Nadia, go ahead. You got your hand raised.
It's more about the scalability. How do you ensure things don't get stale or expire? And, you know, every similar startup I have seen where it requires shipping food, that's kind of that challenge of, you know, with the shipping and ensuring that things arrive not broken, that sort of thing.
All right, terrific. Thanks. Let's take one more. How about you, Paul?
Yeah, I think my question is really kind of the breadth of service. How wide so beverages, but what kind of things do you provide that are available to restaurants? Is it everything or just a few things?
All right, terrific. And we'll take one from the syndicate. Francis is asking, do you have revenue so far? And if so, how fast are you growing month over month? And you have 2 minutes to answer those great questions, Perrin.
Perfect. Yes. So the first question is great in terms of the traditional. So imagine a restaurateur is wearing a million hats, especially the independent operator. So for us, it's a time and cost saving. They really don't have the ability to go out and look at farmers markets or source new products. So for us, it's how do we actually present what's best for a coffee shop or a pizza shop and try to be almost a virtual food and beverage manager for them. So that's part of the value that we're trying to provide, in addition to actually giving them content to help move products. At the end of the day, it's really great to be able to move great products into a restaurant or an establishment, but our job is actually to help them sell through. If we create that velocity, it's a win for our vendor, it's a win for the restaurant, and then it becomes a win for us. So we have a very holistic model. And that's also what leads us into the question of leakage. For us, what we're trying to provide to the vendors is almost a studio content service that they really can't replicate in-house at the scale that they're at. And that's the goal. How do we actually focus on the on-premise area for them, get more liquid on lips when it comes to beverages? But it's not just beverages. We're focusing on a whole variety of products, whether it could be the next clean takeout packaging that's sustainable, or helping them replace straws, or finding the next best beverage, or organic mushrooms that are going to come through a subscription program. For us, it's finding what's right for them. And that's part of what we do. And that's where the curation comes in. And it's really important. In a world that's super busy, that's one of the things that's worked really well for us, is to be that gatekeeper and help them kind of navigate. And that's also what's ended up saving them time and money. At the same time, as an independent restaurant, they have a harder time sourcing compared to a larger vendor. So we're trying to give them more pricing power and more ability to focus that purchasing on fewer vendors to get better pricing through that volume. The question on scalability for us in terms of like food or stale, and just to give you context, we're working with 3PLs. So we're keeping a small amount of inventory as possible. And it's all about turning it. So the goal is not to try to bring in pallets of inventory and keep it in a warehouse. We want to keep as minimal amount and then figure out what's successful, double down on that, and then continue to grow in that regard. In terms of the breadth of service, for us, yeah, I focus on sharing some beverages because there's some great use cases around that. But for us, the goal is to provide everything from paper goods, eventually digital services. I mean, again, we're that virtual food and beverage manager, and I'm running out of time, so I'd love to answer any of them offline. Thank you.
Nicely done, Perrin. Those 2 minutes are tough. Okay, next up, we have Nevşah from Breath Hub. You ready to go, Nevşah?
Yeah, sure. Hello, everyone.
Okay, let's go ahead and share your screen, please.
Do you see my screen?
I do. I'm going to count you in. 3, 2, go.
Hi, I'm Nevşah. I'm the founder CEO of Breath Hub, and we are helping people breathe better, live better. I'm a global authority in breathing sciences field with 20 years of expertise. I have trained over 40,000 people, certified over 2,000 breath workers globally, and created a successful business around breath work. In the past 5 years, we have seen a huge increase in the number of people interested in breath work. That's why I founded Breath Hub. And our early traction shows that I was right. We are over $25,000 MRR, growing daily. Meet David. He has high levels of stress, chronic fatigue, attention deficit problems, chronic pain, and migraines. He wants to heal his symptoms and elevate his performance and well-being, but he doesn't want to use prescriptive medicine, and he needs a tool that is natural, fast, and effective because he doesn't have the time. And actually, some of his symptoms are well-known, scientifically proven symptoms of dysfunctional breathing habits. Headaches, attention deficit problems, chronic pain, depression, these are all symptoms of wrong breathing habits. And these symptoms can be eased or healed by learning a new breathing habit. That's with using our unique algorithm, the unique formula, breath analysis. So he downloads Breath Hub. He starts with breath analysis. We ask him some questions that are backed by behavioral health sciences and understand his breathing behavior. And then our algorithm creates a customized journey for him, and he starts his customized journey 71-day program. He starts practicing breath work between 5 to 10 minutes every day. The oxygen level starts changing. All of the sessions are guided by experts, and he starts performing much better in all areas of his life, because breath is life, and when the oxygen increases, his performance increases. He can also use the app with different sessions whenever he needs it. For example, during the day, whenever he wants to boost his energy or whenever he needs to improve focus, he uses the app. Breath Hub is the only personalized breathwork app created by breathing scientists, and we have all of the breathwork foundations and federations supporting us. None of the other breathwork apps have our expertise or the community, or none of the content either. Our business model is a subscription business model with monthly, 3 months, and annual plan, and we're also building a premium video platform. The path to 100 million is clear for us with B2C revenue, with B2B revenue. We just started working on it, and B2 and also Breath Hub Academy revenue. How we're planning to grow is creating a marketplace with private sessions with teachers, BreathHub Academy, an educational platform with live and on-demand videos, events, building a community. And we see that consumer commitment to wellness is growing like that's never done. And the Global Institute of Wellness is saying that global health and wellness market is expected to reach to 7 trillion by 2025. And to get to our goals, we need 0.2 market share by 2025. And we are certain we can do that. We have a great team we can rely on. This is BreathHub, dedicated to helping people breathe better and live better. Thank you.
All right. Thanks, Nevşah. Well done. Okay. Investors, Jay. Actually, Julia, you're up next, please.
Yeah, it's very interesting. I'm curious. So a couple things. One, what have you seen on the retention side for how sort of engagement has stayed over time? The other question is, if someone is, for example, a member of, Calm or Headspace, would this be a daily practice that is sort of additive to that? Or do you think it's kind of more shifting market share from one medium to another?
All right, great. Thanks. And now we'll go with Jay.
Following up on the Headspace Calm, what's your protective moat? And then kind of long-term, how much funding do you think you need from a go-to-market strategy?
Awesome. Paige, how about you?
Thanks for that presentation, Nevşah. Really enjoyed hearing more about how your B2C go-to-market efforts are scaling, and would love to hear more about how you think about attacking the B2B go-to-market strategy. And my second question would be, in this next round of funding, who are you looking to bring onto your team? And do you have anyone identified for those positions yet?
Fantastic questions. Why don't you take 2 minutes for those, Nevşah?
Yeah, sure. I'm still right. Yeah. Great questions. Thank you. I'm going to start with Julia. So how is the retention? We've been focusing on increasing the retention. We increased the monthly retention from 58 to 71%. Our monthly retention have been increasing with the new features added, and also we're doing challenges. We're educating our community. We're in connection with our community and doing monthly surveys and also interviews. So we've been improving our retention and decreasing our churn as well. And when you look at Calm and Headspace, is this a additive product? Oh, this is an additive product. We don't see ourselves in competition with Calm or Headspace. First of all, breathing techniques and breath work is very different than meditation. The techniques, there are some breathing techniques used in meditation, but those are only 5% of all overall breathing techniques. And what we're after actually is being an ally in people's lives, because a human is breathing all through her life or his life. And how we breathe, the quality of our breathing determines the quality of our lives. So by increasing the quality of our breathing, you can constantly keep on increasing the quality of your life and performance. So we are an ally in people's lives rather than just some, meditation app or just a breathwork app. People can use our app in the long term. And what we're thinking on the long term, to come to Jay's question, we are building new features. We are in phase 1 on the breath analysis and our unique algorithm. That's kind of like our superpower because people love it. And we've seen that people who go on a path on breath analysis keep on using our app. These are the people who use our app the most daily. And when they use the app daily, retention increases. And we need $1 million funding. And I'm going to answer Paige's question, B2C and B2B in the chat.
That's great. Thank you, Nevşah. And there's also another question from Syndicate in the Q&A. All right, next up we have Daniel from HeyHire. Daniel, you ready to go?
Yes, I am. How's it going, everyone? Thank you for coming. Okay,
all right, we can
you see my
go
screen?
Full screen that. Just go full screen. We sure can. Daniel, 3, 2, go.
Hey, everyone. I'm Daniel, founder of HeyHire, smoothly connecting hourly job seekers with local employers. 10 million establishments in the US are understaffed on entry-level labor. And in less than a year, HeyHire was able to fully staff 73 of our 78 business users and helped increase employer retention by 35%. Like Isaac, who needed to staff up his new coffee shop. Isaac is very particular about who he wants to hire and needed a way to ensure his candidates are high quality and, most importantly, local. He'd normally get an inbox flooded with mostly irrelevant spray and pray applications where even the promising candidates almost never respond, until he was introduced to HeyHire, where he hired 74 employees in 3 months. And here's how. First, he created his profile with pre-populated info from Google Maps, added his first position with a description and requirements, created his custom QR banner he could then post outside the cafe on his socials and website for local job seekers to discover. Now meet Jen, student University of Texas, who's looked for a local job with flexible hours. Jen was walking around campus when she ran into Isaac's QR code, which she then scanned, created her profile in 5 minutes, then applied for a server position in just 2 taps. She could then open the map and apply to other businesses around her with that same profile. Now that Isaac has candidates applying, he can open his dashboard, compare his applicants side by side, open Jen's profile to see if she fits, and start a chat with Jen she'll receive as an SMS so they can communicate until the interview is scheduled. Isaac was able to fully staff his new business with top candidates before even opening, making it easy to focus on the other importance of starting a new business. Isaac pays $100 a month for unlimited positions, applicants, chats, and users, compared to other players in the space with a significantly higher time to hire, which is everything in these high turnover spaces. HeyHire has the lowest recorded time to hire of 2 days for 3 major reasons. We geo-vet candidates to ensure they're local and relevant, our comparison tools preventing employers from engaging unwanted candidates, and most importantly, the instant connection between employers and job seekers with our communication tools. We're at 24K ARR and 21% month-over-month growth from only 6 months of bootstrap sales with 96% annual retention. There are 10 million businesses in our industry in the US alone, providing a $10 billion market. Hourly employee retention is 85% monthly, so even the smallest business with 10 employees in rotation will likely need to make a hire every month. To achieve 100 million in ARR, we'll need to reach 0.5% of the global market. To do so, we're executing 2 commitment letters, bringing in 50 plus locations, expanding to Miami in March, building HR platform integrations and strategic SaaS partnerships while utilizing our advisor network to enter the enterprise market simultaneously. The team has a combined 35 plus years of recruiting experience, such as head of hiring for Starbucks and Applebee's. We face this problem firsthand, which is how we understand every step of the hiring process, and our obsession became solving this problem for us and our many friends in the industry. We're HeyHire, and we're changing the hiring game.
All right. Thanks, Daniel. Well done. Steve, we'll start with you first.
Thank you. Thank you for the presentation. A lot of energy. Enjoyed it. I have a question around, in two-sided marketplace, you have the supply and demand, and obviously the hard part here are the applicants. And the question is just how do you just talk a little more about how you would onboard more applicants as you expand, because I don't think you can rely just on QR codes around town. And then also speak to any type of retention statistics you would have or predict in the job once they're placed in these jobs, because that's the bigger problem I think I've been hearing from people. And we had a company in the portfolio that did something a bit of a cousin to what you're doing, probably more complementary, but we kept hearing back that it was the retention more than the actual hiring. So those are the 2 questions I would have.
All right. Thanks so much, Steve. Nadia, you have got your hand raised. Go ahead.
Yes, similar question, complementary. This market is saturated, Indeed, ladders, and I know you touch on your competitors. Do you mind elaborating a bit more on what are you doing differently? Because why would someone go to HeyHire instead of Indeed, besides pricing? It didn't make any, I couldn't understand really what were you doing differently. Are you doing any kind of manual intervention? And if that's the case, then elaborate a little bit more on scalability as well, because you cannot do this manually.
All right, thanks, Nadia. And Paul, you got your hand raised, go ahead.
Yeah, hi. So mine was actually on price. So on the competition grid, it looks like your price was about $300 and the competitors were about $600 to $900. So how did you arrive at the price? And is it something you're considering? You think it's your advantage is having the lowest price?
All right, great. Paige, go ahead.
Can I add on to Paul's question? I thought that you provided great value and had a really fast time to hire. So I was curious, in addition to Paul's question, whether you were thinking of raising your rates, because I feel like you're providing a lot of value to those companies.
All right, terrific questions. You have 2 minutes for those, Daniel.
Okay, thank you for your questions, everyone. Steve, so it is a 2-sided marketplace, and the thing that we've noticed the most, and this is from our feedback that we got from our current employers that are using the platform, their favorite part about it is that their job seekers are actually local. So sticking to these QR codes, which has been 70% of the job applicants found the employers through these QR codes, is definitely what we plan on sticking to, which will also segue into the next question about the retention. So one thing that as well every employer is very happy about is the retention that has increased. It's something we recently started surveying our users about, and it has been proven to be 35% higher. The main reason for that is the vicinity of the location of where the job seeker lives and the place of work. Especially in these hourly jobs, in these entry-level positions, commute is a very big problem. So by making sure that the job seekers are close to the employers, we actually increase retention by that. Let me pull up, sorry. So for your question, Nadia, about the market being saturated, our key difference is two things. First of all, like I said earlier, making sure that those job seekers are local, and then also the communication. So one thing that we've always seen is that instant connection between job seekers and employers is really making the time to hire super low. By having the employer communicate with the job seeker right away as soon as they apply, we've seen in multiple cases a time to hire of just a few hours, giving the employer the ability to catch the job seeker while they're still around and call them for an interview on the spot. So for Paul, in terms of price, we did start this as from our experience with paying a lot for every other platform, and I see we're running out of time. I'll answer this question offline. Thank you for your questions, everyone.
All right, great job, Daniel. All right, Rhian, I'm going to try to have you go again. If our backup is that we can run your deck for you if this doesn't work, but we want to make sure you get your chance. So Rhian, can you go ahead and share your deck?
Yes, I can. Apologies, everybody.
All right, it happens. Okay, I'm going to count you in again. Rhian, 3, 2, go.
Hi, everybody. My name is Rhian Beutler, and I am the co-founder and CEO of the Shopify Plus certified app Govalo, where we are reinventing the digital gifting experience. Meet Bobby. He's the VP of Commerce for Felix Gray, and he recently migrated from a custom CMS over to Shopify Plus. Now, they immediately started using Shopify native gift card solution because Felix Gray loves gift cards, but Bobby has a problem. You see, with Shopify's native gift card solution, you can just add a denomination to the card, and then the buyer gets the email. The gift recipient never gets anything. That's not really a gift at all. Now, this doesn't work for Felix Gray. It doesn't work for their strategy, and that's when they found Govalo. With Govalo, he's able to send a gift card directly to the recipient, add the email in, pick a delivery date now or in the future, and of course, personalize it with a gift note. Plus, he loves what's under the hood even more. He loves that you can look at total redemption and that the business analyst team looks at all of the users or all of the gift recipients, and the CX team likes this because they can search the admin in case there's any kind of challenges. So with Olivier, let's say Olivier says, whoa, I didn't get my gift card. Well, you can see it was issued, it was opened, and it was used. And if there is a challenge, you can resend an email, or if they're very unhappy, you can always update the balance. Now, the other thing that folks love on this is the gift card from the admin, but most specifically, the bulk component of this. This is used in Influencer Strategies by Felix Gray and corporate gifting. Now for the configuration, this is so the customer journey is absolutely flawless. This creates end-to-end, perfectly branded Felix Gray experience. And with the integration such as Klaviyo, we make sure that the gift cards keep being redeemed and that LTV stays high. Bobby says that since installing Govalo, we've seen a 250% increase in gift card sales, and he's not alone. Govalo is trusted by over 980 brands, from D2C darlings like Baboon to the Moon and Brightland to household names like Mikasa, GQ, Fellow, and Allure. We make money in two ways. One is a SaaS fee, and the second is a take rate based off of gift card issuance. Our revenue so far has been up and to the right, with Q4 being our largest quarter with $81,800. Our competitor analysis is this: we stand head and shoulders above the rest. We offer giftable subscriptions, multiple email integrations, corporate gifting, and giftable products, and we are just getting started. Our road to 100 million is clear. In 2023, we're building point of sale Hub, which is a backwards compatibility. In 2024, this is our Stripification mode, platform agnostic API. 2025, we're taking on Blackhawk, 360 omnichannel stored value. In 2026, we rocket ship with platform agnostic fintech infrastructure. The team is me and my co-founder and 3 fantastic engineers. I've been building the Shopify ecosystem for over a decade and previously bootstrapped a company to 25,000 active paying users. And I'm a Shopify developer champion. And my co-founder was early at Shopify pre-IPO and led the Shopify point of sale team to market. We have advisors such as John JML, the former CTO of Shopify, Kat Cole, the president and COO of Athletic Greens, and my name is Rhian Beutler, and I am reinventing the digital gifting experience. Thank you.
All right, Rhian, yay.
Yay.
Now you want to try to put your video back on now for the Q&A. Okay, back to Amit. Question for Rhian.
Yeah, great job, Rhian. I guess my question would be primarily on like a go-to-market motion. How are these folks finding out about you, and how are you accelerating kind of acquiring customers?
All right, great. Paul, how about you?
Yeah, actually, my question was on customer acquisition cost. How did you reduce it by?
Excellent. Jay?
So some of the Shopify store, I love this, but my question is twofold. One, there are a few hundred apps in the gift card space within Shopify. How do you separate out? And then what's the risk of Shopify improving their gift card native solution?
All right, I think those are 4 separate questions. So go ahead, Rhian, you have 2 minutes to answer those, please.
All right. Let's first talk about how we separate out. So I love that question. Love that you have a Shopify store. Obviously, I'm a big fan of Shopify. So here's the deal. We're a Shopify Plus certified app, which means that we're actually in a cohort of 98 apps as opposed to the almost 9,000 of the Shopify apps, at large. And so that means we are totally differentiated, and the bulk of our stores are actually Shopify Plus. Now, I'm not concerned that Shopify is going to build this, and here's why. Let's look at Shopify email, for example. I know that you're a user of Shopify, so you're going to know what I mean. So Shopify email, they launched it, and everyone's like, meh. And then Shopify invested $100 million into Klaviyo. So I'm really not worried about them building something. And I've also spoken to their corp dev team, and it is nowhere on their roadmap. Go to market. Let's talk about this. We are going to market and have gone to market in 4 main ways. 1, agency partnerships. We are partnered with the biggest agencies in the game. 2, technical partnerships. That includes Recharge Payments, Bold Commerce, Mesa, Klaviyo, and a lot of the other players and unicorns in the space. And 3, Shopify Plus directly, and Shopify are sending us referrals. That's what's so great about being in the Shopify Plus program. We had to meet all of these requirements. And with that comes the really big brands, the publicly traded brands, the brands that quite frankly do the volume and make sure that the lights stay on. And then 4 is outbound marketing. We always love outbound marketing. And yeah, the Shopify App Store is nice, but where we really make the money and how we get people in is getting in front of people, marketing ourselves, and doing webinars, podcasts, things like this. And let's talk about CAC for a moment. We actually have a CAC of 0. At the moment, we do not pay for any advertising at all. It's all organic because my presence in the ecosystem is so long-standing, shall we say. I don't have to pay for the press and market, and the ads in the App Store don't work. So we don't have any CAC. And so far, we have been acquiring customers like we should have a high CAC. Thank you so much, everybody. I appreciate it.
All right. Thanks, Rhian. And founders, please do keep checking the Q&A box for more questions. Next up, we have Lamont from Melody. All right. I'll make sure I can hear you, Lamont.
Hello.
Hello. All right.
Yes.
You got 3 minutes. 3, 2, go.
Hello, everyone. I'm Lamont, a co-founder of the Melody app, a workflow tool for music creators. We are the fastest, easiest way to find melodies. What is a melody? In today's music industry, the word melody refers to a sample or loop. The global market for music production software is currently $4.7 billion and projected to be $12.1 billion by 2027. Splice is an online sample retail website founded in 2013. They're currently valued at $500 million, have 4 million paid subscribers and 150 million ARR. We're doing something similar, but with the mobile-first approach tailored to the next generation of music creators. Like Raphael. He's one of 4 million producers selling beats online. He works a 9 to 5, so he has to maximize his time when it comes to making music. Raphael is frustrated with the current process for finding melodies. Applications and websites available to him are time-consuming, unorganized, and immobile. He discovers the Melody app through an ad on Instagram. Raphael downloads the app and creates an account using his email address. After logging in, he loves the fact that melodies instantly start to play to create inspiration. He's looking for a particular sound, so he uses the instrument and vibe filters to narrow down the selection. Now he only hears melodies based on the selected filters. The first two weren't for him, so he swipes left to skip. Then he hears a melody he likes, so he swipes right to save it to his folder for later. This melody is automatically saved in his folder within the app. He keeps listening and eventually hears one he loves. He wants to work on it immediately, so he swipes up and emails it to himself. This process used to take Raphael upwards of 30 minutes, but in less than 5 minutes on the Melody app, he's able to find a quality melody and get to work. Raphael used to produce 5 beats a week before discovering the Melody app. Now he's producing at least 20. This led to more consistent uploads to his beat store and a 3x increase in sales. We increase his productivity by streamlining his workflow. Our business model is subscription-based. Customers pay $7.99 a month for unlimited access to thousands of melodies. Last month, we changed the top of our sales funnel to a 30-day free trial. This, in conjunction with the marketing activation, resulted in a 400% increase in subscribers. We went from 70 to 350 subscribers in the span of 1 month and consistently growing already this month. The free trial allows subscribers to download the experience that makes it what makes us different. Our mobile first approach, quality control, better user interface, and our industry credibility set us apart from the competition. The path to 100 million is laid out here. 150K subscribers gets us to 10 million. 1.05 subscribers gets us to 100 million ARR. But how do we get those subscribers? Growth drivers such as our partnerships with our friends in the music industry, creating opportunities for the community, targeted media, and genre expansion help us along the path. Grammy Award-winning multi-platinum producers and music industry insiders with over 30 years combined experience make up the team. I'm Lamont, a co-founder of the Melody app. We are the fastest, easiest way to find melodies. Thanks, everybody.
All right. Thanks, Lamont. Yeah. All right. Julia, how about you? A question for Lamont.
Can you speak a bit more about the competitive landscape of smaller players, maybe that are doing similar to what you are doing?
All right, terrific. Paige?
Hi, Lamont. Great presentation. Loved your energy. You talked about having a 400% increase in your number of paid subscribers. I would love to hear more about what percentage of those are coming from the different go-to-market strategies that you mentioned on the slide previous.
All right, terrific. How about you, Steve?
Hi, Lamont. I also loved your energy, and I loved niche SaaS, so I was very interested in watching you go through the presentation. My question is around AI. We had a company pitch us the other day that's doing all these AI, something fairly similar to what you're doing, but with generating those melodies with AI. I'm wondering if you find that as a competitive threat or actually an opportunity moving forward.
All right, terrific. Let's grab one from our syndicate member. Chris is asking, are the melodies generated with AI? Do you have any copyright concerns? Awesome. So those are great questions. You have 2 minutes for those, Lamont.
Thanks for the questions, everybody. I appreciate it. Copyright concerns regarding the melodies. No, we do not have concerns about those, and they're not generated from AI. Actually, our melodies are created from actual people, producers. They make them relationships that we built over the course of the years and referrals. In order to be able to put melodies on our app, you had to have been referred, or we have to know you, be within our circle. That alleviates the problem of somebody basically forging their work. We work within that kind of circle. Copyright, we don't actually own the melodies ourselves. It's a sense where people put them on our app because the opportunities that we provide for them is the reason why they do that. They want to get the melodies out to more people, and we help them do that by our customer base and relationships that we have. As far as AI and competitive opportunity, I think the AI is something we would use more so to help the experience for our users as they continue to swipe and we get more data on their swiping routines and patterns. The AI would eventually help us to filter out what they actually hear, because right now it's a shuffle type of thing. So every user who logs on hears different melodies at different points in time. Nobody hears the same thing, and it continues to shuffle. But the AI is something that would definitely help us create a better user experience. The 400% increase in subscribers, how do we get them? That actually came from a marketing activation we did in December. What we did is we gave away a laptop and we gave away a bunch of plugins from some software companies that we're partnered with. And we had, used influencers to market and promote it. And that's what resulted in that such of an increase. And that's kind of a formula we've been starting to use now. We've kind of decided and just basically ciphering through the people we want to use for marketing activations. And that was the reason for that increase. As far as the competitive landscape, some of the smaller players, we're not concerned with them. They are actually royalty free, which we are not. We actually give 10% of the publishing to our producers who put melodies on the app, which is an advantage that we do. Being that we are creators and we come from that space, we're really about creators and giving back to them. We just feel that's fair. Hopefully we'll have more time to talk offline. Thank you for your time, guys. Bye.
All right, well done. And there are more questions for you in the Q&A box. Founders, keep checking there, please. Next up, we have Lex from United by Zero. You're right ahead of me. You're ready to go, Lex. Can I hear you? I can't hear you.
Thank you, Jackie. I am.
There we go.
All right.
I can hear you now. You got 3 minutes. 3, 2, go.
All right. Thank you. My name is Lex, the founder of United by Zero, and we are building the future of sustainable consumerism. So we know people want to shop sustainably, and we know they're willing to pay a premium. But right now we've got this problem, this say-do gap, where people say that, but they're not following through with their actions. And this is leaving a tremendous amount of money on the table for brands, $137 billion in the fashion market specifically. And there's 2 main reasons for that. Consumers struggle to find sustainable clothes with their shopping, and they don't know what makes something sustainable. We solve both of these problems for our brands and for consumers. So meet Meryl. She's one of the 81% of millennials who want to shop sustainably, and the 66% that would spend more on a more sustainable product, but she doesn't know where to go or who to trust. So the next time that she's on her favorite fashion blog, she discovers United by Zero. With a few clicks, she's able to add our extension to her browser. Now she's shopping on Anthropologie, a site she knows. She can, with one click, find more sustainable alternatives from independent brands in the same style that what she's already shopping for, using image recognition and MLP, so that she can go from Anthropologie to her new favorite brand, Laws of Motion. And Carly, the founder of Laws of Motion, she loves this. She spent years developing the technology and the supply chain necessary to create some of the most sustainable products on the planet. So now she needs 2 things. She needs to demonstrate that to people who care. We send those people to her front door, and then we work with Carly to do a full spectrum product analysis so that we can create the information that is necessary for her to be able to put on her website to show her customers why she's making more sustainable products through a Shopify app with an easy integration. And here's the real magic. We get to track people's behavior through this entire process, so we can understand and close that say-do gap. So we can see that 80% of our users are going to Zara. Or sorry, when they go to Zara, they check for more sustainable alternatives, but only 20% of the time do they click through. Who are those 1 in 5 people that are at the leading edge of sustainable shopping? What's motivating them? How do we use that consumer data to unlock these billions of dollars in this sustainable shopping market? Right now, we have 2 revenue streams. We have an affiliate revenue stream through driving customers through our extension, and then a SaaS platform for the environmental footprinting and putting that on the store in the widget. And this is the best part of this product. It pays for itself. Because we are a revenue stream for our brands, it can pay for the SaaS module. We launched the extension last year. We have over 3,400 users that we've gotten organically. And we launched the SaaS product in December. We signed our first customer in 10 days. We have 70 brands that we already are working with through the extension, and hundreds of brands that our users have defined as where they want to see this product work, which is how we are going to grow to $150,000 in monthly recurring revenue with only 413 brands. But we see this as a tremendous opportunity to really tap into this generational shift in shopping by expanding to other market segments like footwear and home goods, and by moving from the SMB market upstream and leveraging that consumer data that we have to really close this say-do gap and realize those billions of dollars that are being left on the table from this generation of sustainable shoppers. My name is Lex, the founder of United by Zero. Thank you.
All right, Lex, well done. Under the time. Okay, let's go with Amit. Question for Lex.
Yeah, great job. I think the question from my side is, how accurate is the recommendations, like in terms of providing alternatives? And then second, overall, what percentage of time are your users selecting one of the other products?
All right, terrific. Thank you. Jay?
Can you share some of the results from some of your early brand partners, what they're seeing?
Awesome. Julia?
Can you share more about the go-to-market strategy? And then also, how are you vetting vendors to prevent kind of greenwashing, right? How are you looking at that at scale?
All right, great. And how about you, Nadia? Do you have a question? I'll come back to you. Let's try to grab one.
It was already mentioned, like, how do you prevent greenwashing, since right now there is a lot of that happening? Yep.
All right, terrific. Why don't you go ahead and take those, Lex? You have 2 minutes, please.
Absolutely. So I love the greenwashing the vetting vendors question because it gets to the heart of the science. So how do you figure out how much carbon, how much water, how much of these core constituencies go into the products that we have? We use that by figuring out what the bill of goods of materials is. We can plug into an ERP that they're already using and then download that through a CSV or an API integration. We can take that bill of materials and then understand what kind of carbon emissions, water usage go through that, and then map that to their overall supply chain to create a carbon footprint. It's called a life cycle analysis or an LCA. Usually it costs between $5,000 to $15,000. We're able to do the top part about that for $50 a month through the software that we've developed. And we're seeing LCAs being democratized. So this is something that the entire industry is being compelled to produce because the SEC is regulating it for large companies, and New York State is launching the Fashion Act, which is focusing on this, and EU is launching product declarations requirements for the textile industry. So basically all this information is moving towards something which is both going to be publicly available and vetted. And so we're taking that information and saying, what do you do with it now? How do you turn that into ROI positive? And that's where putting in front of customers and understanding how they're reacting to it is going to be the force multiplier for making sustainable clothes in a way that gets you an ROI or a sustainable everything. What is our go-to-market strategy? Working with ERPs allows us to access all of the brands in their wheelhouse. We have one that has over 500 brands in their ecosystem that we're working with. And I have a podcast called Who's Saving the Planet. And we've gotten a lot of traction through that by being somebody in the space that is able to develop a community there. And the best thing about this also is that it's a revenue positive acquisition stream. So when our product is on our brand's products, the people that go to their website see United by Zero as a brand validator, and that brings them back to our front door. What kind of traction have our brand partners seen? We're sending traffic their way at zero cost to them, so they love that. It's about a 14% effective rate from downloading the application to getting them on their site. Love to answer more questions when you have or later. Thank you.
All right, great job, Lex. All right, and for our 7th founder, we have Moy from Vert. Are you ready to go, Moy?
I am. Hi, everybody. Good
Excellent. All right.
afternoon.
All right, Moy, I'm going to count you in. 3, 2, go.
Hi, I am Moy. I'm a professional athlete for the Northwest and co-founder of Vert.run. We are the training app for the outdoor athlete, and we are transforming how people access the outdoor. Our first step is to own the trail running vertical, which is the fastest growing outdoor activity at the moment. And our early traction proves that we are on the right track to achieve it. Let me show you how. Meet Emily, one of the 3 million trail runners that joined our sport in the last year. And after watching a movie about a famous ultra runner, Lucy Bartholomew, Emily decides to run her first ultra marathon. Emily lives in New York, so she can't train in the mountains. In Vert, she finds the right training plan for her, designed in collaboration with the best athletes in the world. She actually finds a plan that it was designed by Lucy Bartholomew, the same athlete who inspired her journey. Then Emily tells us about herself and her next race. And with this information, our system automatically creates a personalized version of Lucy's plan for Emily. Like you, like me, Emily have a busy schedule. So she personalizes her training by moving workouts. She can also add an easy week when she needs to. And she makes sure that her training is right on track by following her achieve workouts, energy level, and training volume. Every week, Emily chats with her Vert coach thanks to our in-app chat. So when she wonders what shoes to buy for her next race, for example, she gets personalized expert support. Emily shares and connects with a strong community of runners from over 100 countries, and she stayed engaged and motivated thanks to our in-app challenges and our curated content. With Vert, Emily gets a holistic, personalized support for her trail running lifestyle. And after 17 weeks of training, she did finish a race and became an ultra runner. Emily pays $25 a month for her Vert subscription. She's one for 820 active paying customers. 8 out of 10 free trial started become a Vert.run customer, and our LTV to CAC is 8-to-1. Our MRR from December was $13,000, but we are ready to scale it up. We have the advantage of partnership-based growth. That's why we're multiplying our partnership with athletes, and we're also partnering with the biggest race series in the world. That is on top of our existing and more standard marketing actions. Vert is the only one that have unlocked at scale personalized training in the outdoor industry. But to bring it to a new level, we're starting to implement AI training in 2023. In our path to 100 million, we will expand from training subscription to affiliate revenue powered by personalized recommendations of gear, races, nutrition, and more. 12 million trail runners spend over $20 billion a year in the US alone. But this is only our beachhead market. Once we own the trail running vertical, we will expand to win other verticals like road running or hiking, for example. Our vertical focuses strength and a proven path to success. Twitch first owned the gaming community before expanding and being acquired for almost $1 billion. Amazon first conquered books before conquering retail. We're a highly technical, skilled, and data-driven team, but we are also endurance athletes ourselves. We live the outdoor lifestyle to the fullest. Thank you, everybody. I'm looking forward to your questions.
All right, Moy, great job. Thank you. All right, Paige, how about you? Question for Moy.
Hi, Moy. Thanks so much for your presentation. I would love if you could dig more into your competitive differentiation between Strava, an app that I've seen do really well. You talked a bit about personalized at-scale coaching, but I would love to hear more about how you think about competing with them from a go-to-market perspective.
Thanks, Paige. Steve.
Hi there. I enjoyed your presentation. I actually ran an ultramarathon once. So where were you like 10 years ago? So I was definitely watching with close laser vision. But more to the point is thinking back to myself back then. Like, how do you actually deal with customer acquisition? Like, where do you find those? You know, you said there's 8 million ultramarathon runners. How do you find them, and what's your acquisition cost, and what's your projected retention on that?
All right, terrific. Back around to Amit.
One question is just curious, what's the longest race that you've run yourself? And then second question, as you think about the products to be sold on the platform, like which ones would be the most likely candidates for first products for the affiliate side?
All right, awesome questions. You have 2 minutes for those, Moy.
Thank you for the questions. They're great. So regarding to the competitive, mainstream sports and fitness apps are mostly focused on tracking rather than helping their users improve, right? We're changing that. Vert exists to help athletes of all kinds improve their physical and mental fitness through personalized guidance and real human support. And we do that at scale. So our customers' feedback or usage or growth shows that we have built something that people love and that really works for them. And this is only the beginning. So this is one of the ways of how we differentiate from Strava, for example. Go to market and how we acquire customers. We see partnerships as a great driver of growth. We've partnered with athletes, the best in the world, that help us validate the platform, create great content, and at the same time, the people who follow those athletes join our community because they want to train like their heroes. And then we also partnered with races. We know that people pay for a training plan when they have a clear objective. That's why by going through races or race series, we make sure that we're in the checkout cart, for example, of a race sign-up process. So when they can just add, like a training plan to their next experience. About retention, we have a 69% retention by month 5, and this is thanks to the wow moment, which is the human connection that our customers create with their coaches and the simplicity of the platform. The fact that we have a human coach that is checking on a weekly basis to our customers allow us to provide this accountability that help them stick around. Then regarding to product sold, people come to Vert with different questions. The first one is how should I train for my next race? But the next question is hey, coach, what shoes should I buy? What backpack should I buy? And we know that trail runners spend around 3 times more than a road runner does in the sport. This is a fast growing sport and it have a huge lack of innovation, which we are solving. Thank you, everybody. Oh,
all right. Oh, go ahead. Yeah, I wanted you to answer that you're running. How was the longest one you did?
The longest one is called the UTMB, 170K, so 105 miles.
All right,
not crazy at all.
Thanks, Boyd. All right, that's our cohort. Now, investor judges, comes the hard part. I am going to ask you to give us your top 3 of the 7. I am going to call you for your top 3 as I did with the questions, but when I call on you, I'm going to ask you to give us your top 3 in backwards order. So when I call on you, can you just say my number 3 is, my number 2 is, and my number 1? But when you say 3 and 2, don't say the Don't say anything, just the name of the company. That's it. But when you say the number one, then please do go ahead and say a few words about why you voted that company number one. All right. I'm going to call on you. Amit, are you ready to give us your top three? And syndicate members, we're going to let you vote as well. We have a poll ready to go. So let's do that actually. Andre, can you go ahead and launch the poll? Now, can our guest judges not look at the poll? We'll let that go for a minute and have the syndicate members vote for their top. And then I'm going to call on Amit to give us your top three in backwards order, please.
Sounds good. Let me know when to go.
Go ahead.
Great. So number 3 is Breath Hub. Number 2 is Vert.run. And number 1 is Govalo. And the reason being, I think, just the credibility that you already have in the sector, being that familiar with the Shopify ecosystem, the fact that you've been able to get press and customers just based on reputation and create relationships with pretty high profile customers. And I would say, like, it was pretty clear to me that you have a very deep understanding of what Shopify as a platform is going to do, and kind of have taken the time to create those relationships that really matter.
All right, thanks so much. Paul, we'll have you go next.
Sure. So my number 3 was Breath Hub. My number 2 was Vert, and my number 1 was EATERCLUB. And the reason for that is just, it seems like it's really a solution that the world needs, right? And that's very often what I look for when I'm investing, is a problem that really needs to be solved, and I can see the value to the restaurants.
Terrific. Thanks, Paul. Jay, you're next, please.
My number 3 is EATERCLUB. My number 2 is Breather Hub, and my number 1 was Govalo. Reason I picked that is because their domain expertise within Shopify and the growth, not just in Shopify, but in all e-commerce platforms right now.
All right, terrific. Thanks, Jay. Julia, hi, you're next, please.
My number 3 is United by Zero. My number 2 is Breath Hub, and my number 1 is Govalo. I agree with the previous sentiment. I think you have an incredible pitch. I like your expertise in the Shopify ecosystem. The advisory board is very strong as well, especially the CTO of Shopify, to help navigate that's not a risk.
All right, thanks, Julia. Nadia.
My number 3 is HeyHire. Number 2 is Melody, and number 1 is United by Zero. I graded all of them in 3 areas: scalability, experience, and replication. I liked United by Zero. For all of those, they score the highest. And also, from what I see, what I have seen is that there is a big push for the work that Lex is doing, and it's a trend that I don't see going anywhere. It's going to grow. So I think they are an early entrant, and they are doing the right move. So yes, United by Zero.
All right. Thank you so much, Nadia. Paige.
All right. My number 3 is United by Zero. My number 2 is Breath Hub, and my number 1 is Govalo. Rhian, it was clear that you built a strong community equity in the ecosystem, which I think is really difficult to replicate and is a strong competitive moat. And I also think that you did a great job with your storytelling and taking us through the traditional user journey of one of your users. I think that really stood out. It was very clear what the problem and solution were. And then you went into your personal credibility and your team as well. So really enjoyed your presentation.
Thank you so much. And Steve.
I enjoyed all the presentations, and we have to rank them. So here we go. In 3rd place, I put it, or number 3 is Vert. Number 2 is Melody, and number 1 is EATERHub. In the very unscientific way, I might have been biased that my first startup that I did in my entrepreneurial journey was EATERCLUB. I was the founding CTO there a zillion 1 years ago, before we sold our souls to the devil, aka Google. And I just understood, that there's a true problem there with the restaurants. Like it is such a dog-eat-dog business. It is such a changing business. It's such a way for differentiation. So I think all 3 of these reflect a niche type SaaS business. But I thought EATERCLUB, built out a pretty strong value proposition.
All right, great. So Andre, how'd we do? for this week. It's going to be a lot of, everyone got votes, so it'll be fun.
Thank you so much for voting, everyone. It was close. So in third place with 4 points, we have Breath Hub. And in second place with 4.5 points, we have EATERCLUB. And in first with 8 points, we have Govalo.
All right. And how do we do on the poll?
For the syndicate, in first with 24% is Govalo. In second with 21% is HeyHire. And we have a third place with Breath Hub at 15%.
All right. And
well done.
For everyone, we do this week over week for about 15 or 16 weeks. And who are our top three? Say the points. Who are our top three overall for the cohort?
For the entire semester.
For the entire cohort.
For the whole, yeah, all 15, 16 weeks. This is exciting.
So our final total after the course of the program, in third, we have Breath Hub. In second, we have United by Zero. And in first is Govalo.
All right, well done. Great job to all the companies, and congratulations to Jackie and the programs team. The Launch Accelerator is now, I think we're starting our 27th.
We're midway through 27th and actively recruiting for LA 28.
Actively recruiting for 28, yes. And so this is a passion project for us. We love working with founders early. The ideal companies have a couple of customers. Maybe they've raised a friends and family round. They've got some level of traction that we can help accelerate. We do a lot of hands-on with the companies to talk about product, market fit, company growth, and really important stuff that I think a lot of other accelerators may not work on. Making sure the accounting, HR, legal, governance are really tight. Why do we do that kind of blocking and tackling stuff? Well, those things sometimes wind up in companies failing unnecessarily. Great founder, great product, great customers, great market, but something in the legal, accounting, operations of the company governance isn't set up properly, and the company flips over, the car explodes, and it's a wasted investment in time for everybody, most of all the founder. So we try to work on both of those things, really making these companies run in a very professional manner and create stability in the companies while helping them work on important stuff like product market fit, product velocity, sales, et cetera, and raising money, of course. If you have a company at any time, you can just contact Jackie at launch.co and just directly introduce it. We really appreciate that. We do a carry share. We'll give people some share of our carry if you do. We love referrals. We only accept 7 people to the program. This is not trying to have 50 or 200 people. It's a very bespoke program. We do have a larger program called Founder.University. That is a 12-week course that is essentially free for founders. We actually make them pay $500. And then if they come to all 12 weeks for 1 hour a week, we give them the $500 back. We charge it back. So we just want people burning seats. That's led to a mid-90s% completion rate for the program, which I think has 300 people in it or 400 people in it. We've done 3 cohorts. So Founder University is for people who have an idea for a company, an MVP, maybe no revenue, maybe they got a couple of free customers. So that's our funnel, Founder University, then Launch Accelerator. And of course, we do direct investments from our fund, and we have the largest syndicate in the world. And we are placing more bets this year and going to be more active in 2023 than over the last 2 or 3 years, when market was a little overheated and we were, I think, mostly trying to sell shares in our company and get exits for our LPs. We're also raising our 4th fund publicly, Launch Fund 4. If you want to meet and talk about that, we filled up all the accredited investor slots, unfortunately, but we still have qualified purchaser slots. So if you have anybody or LPs you think would be interested, you can email me directly, jason@calacanis.com for life. My first name and my last name. Any other housekeeping that I missed, Jackie? Everybody loves the housekeeping. And just great job to the founders, by the way. I know it's a hard time to be a founder. You got to be super focused. The funding environment is going to take 10 times more effort to raise half as much. That's like a 20x lift. And you got to be really focused on what matters. Theatrics and market size are not the drivers. Just a handful of customers who love your product, I think, gets angel investors and seed funds to write a check. How polished your pitch is, that's nice. It's good that you have clarity in your pitch, but proof is in the customers, proof is in the users. And so if I had any piece of advice going into 2023, it would be to really study your customers and delight them. That's what's going to get this investor, and I think many of the investors here, to actually write a check in a down market. Takes a lot of courage to make bets during this kind of market. I think it's actually the best time to make, having lived through this before. It's actually the best time, but paradoxically, even for capital allocators, and it's their job, it's hard for them to make investments in a down market, even though it's in their best interest, because the prices are, the entry prices are lower and the opportunity is greater. All right. And did I miss anything, Jackie? Should I take a question or two since we got everybody here? Any questions?
I think you did great. Just a reiteration of, please introduce us to founders. We love to work with founders at all level, even before they have an idea. Through
Founder University.
Later stage.
Absolutely. Any questions for me from other investors? I'll take a question or two if anybody has a question, or founders, or anybody in the Q&A. Sometimes people have questions for me.
Jay, what's your camera setup? You're so clear.
Oh, thank you. They will post a link to my rig. I think it's thisweekinstartups.com/rig. But somebody will post it right into the chat right now, and you'll actually see, Jason's setup. So I get this question so often that we literally tell everybody. And I think we probably should, in that link to, when we link to those things, put an affiliate link on it and make a ton of money. But we don't. Any questions for me? Oh, there's a Q&A box. I'll take a couple questions. I'm in a chatty mood. Question for Jason: what's the biggest investing opportunity this year? I think investing, it's a great question. I have always believed that we should be independent of vertical, because the great innovative companies sometimes don't fit into a pre-existing vertical. Now, for the founders we like to invest in, we would love to see more startups with 3 founders, with 2 of them being developers. Why? Well, typically one founder quits, in our experience, and then you still have 2 founders. If you bet on one founder and they quit, well, your investment goes to 0. So on a very pragmatic basis, 3 founders is a great place to be, knowing one might move on. Maybe they move on in 6 months, maybe they move on in 2 years. Additionally, you really want to have founders who can build product in a market like this, especially. You don't have the ability to just raise buckets of cash and throw it at a dev shop, or, pay a bunch of money for developers. So if you can have a developer and a designer, a front-end developer, a back-end developer, whatever, a full-stack developer, and a growth hacker, maybe, somebody who actually knows how to do growth hacking, not just like, tweet, but they can actually like buy ads or do viral loops. That to me feels like a really powerful cohort. A world-class UX designer, 2 developers, an incredible growth person, 2 developers. We see a lot of folks who have ideas. And you know what? I'm an idea guy. That's kind of what I've done my whole career, but I wouldn't invest in me, as a solo founder. And that's why I had Brian Alvey when I did Weblogs Inc. He was my CTO, and that worked really well as a founding cohort. Having the 2 of us made us much more fundable. So I think being self-aware of that. The business model matters. So people who are focused on business models that can have a very high gross margin, so that we can get, for our LPs, 50 to 100 times our money back, a return of 50x or 100x. Now, we've been talking about this in our daily programs meeting that Jackie runs, because I'm raising a fund right now. And as I'm out there raising a fund from LPs, you notice things, and they're very enamored with the secondary sales we did for investments that returned 50 to 500x our money. And we sold 10% or 20% of our shares, or we had Robinhood go public, or we were able to, Uber went public, obviously. Paradoxically, or shockingly, LPs are really interested in the returns. What we found was we, even as a fund, got a little distracted. We did a little detour into CPG. We did some hardware companies. In a lot of cases, those were a road to nowhere, because the gross margins were so low that venture capitalists downstream from us wouldn't invest in them. So the market is, I think, very, very, very focused on high margin software, SaaS, subscriptions, consumer subscriptions, marketplace revenue, fintech, just the business models that work. And the business models that are low margin, they're there's going to be more discipline in the venture space and less funding of those. So we're very focused on that. That's how I look at opportunities. Do we have the right team? Do they have good product velocity is another big one for us. So the reason to have 2 or 3 founders who are all builders, we back builders here, is the product velocity goes up every week in the accelerator or founder university. If we don't see product velocity, it's kind of like, okay, the person's waiting to raise money in order to have the product advance. That's also a road to nowhere. If the product's not advancing, VCs and seed funds are probably not going to invest. How can we invest in these companies? Great question. We challenge all of the folks at Launch Accelerator to go out and find a lead or do a party round. When they hit a certain threshold, then we will look at the terms they were able to get. We don't want to lead their rounds coming out of the accelerator. We want to teach people how to fish. And if they, in fact, can get a lead investor or get a party round going, then we will fire up a syndicate and we evaluate the terms they get. If they get some insane terms, $100 million valuation, we might pass on that. But generally speaking, we will invest in typically 5 of 7 graduates. Am I about right, Jackie?
Correct.
Yeah. So 5 out of 7, we wind up running a syndicate for and investing further in. And the 2 that we don't, it's probably because they didn't clear market themselves or they chose not to raise. It can be one of those 2 reasons. It's not always because they weren't able to. Is the Bay Area coming back? The Bay Area is doing great. The city is a complete, utter disaster. The amount of office space, it's a ghost town. It's a terrible place to run a company. It's still, even with rents being down modestly, it's still a terrible place to locate your company. But the wider Bay Area is a great place. So East Bay, Peninsula, even up in Napa, I think it's a great place to still be because of the talent and the number of people in the venture capitalists still doing great. How's Launch Fund 4 going? Unbelievably well. $47 million in requests. And we've closed a bunch of that already. And we filled up all the accredited investment. I can talk about this because we did 506C public raise because I wanted to kind of democratize venture capital. We have far too many accredited investors than we can accommodate. There's a cap of $10 million, 250 accredited investors, and then 2,000 what's called qualified purchasers. Those typically have a higher net worth. So we have filled up the accredited investor slots. We have a wait list. You can join a webinar if you want to join a webinar as an accredited investor and join our wait list. If you join the wait list and you make a commitment, we will then give you more ping pong balls. In other words, a greater chance of getting into Launch Fund 5. But the chance of getting into Launch Fund 4 are low, but I'm happy to walk you through the deck. And I'm doing 2 more webinars. In the first 5 webinars, it was incredible. We had hundreds of people show up for each. Now we're having, dozens of people or a dozen QP show up for each. And I'm meeting with them. And then I'll go on to fund of funds and institutions to raise. And so the worst possible time to raise a fund, but we're doing just fine. Probably be a $50 to $150 million fund. And I'll spend a year doing it. If I had raised it in 2021, I probably would have spent 10 days doing it. So timing is everything, even for us capital allocators. But it is what it is. But the best time ever to deploy money, I believe, is the next 18 months to 36 months. We're seeing valuations that are $5 to $10 million in the seed stage, which is where Uber, Calm, for people here who are raising at 5 million and feeling terrible about it. Oh my God, I should get 15. Uber and Calm and DataStax and a bunch of other companies I invested in all raised money at 5 million. No shame in the game. If you raise 500 and you had a $5 million valuation, dilute 10%, then you raise $1 million at 10, then you raise 10 million at 30 or 40. It's just fine. What percentage of LA founders typically come from Founder U? That's a new thing. So is it 1 or 2 per class, Jackie, now? Maybe 1 per class?
Yeah, it's been 1 per class for the last 3 or 4 cohorts. So we've had 4 so far.
Amazing. So there you have it. There's the exact number, 1 out of 7.
And that's just the 12-week Founder U. We've had about 12 or so from our 2-day Founder U.
Yeah. So we have an intensive 2-day one, 8-hour days, and then we have this 12-week one. So both are incredible things to come to. Jason, do you see trade shows as a good place to get initial customers, or is the cost of entry too high? Great question. I think going to events with very specific metrics is how I always did it. So when a sales executive asked me, hey, can I go to this event? I'd say, great. How much is it going to cost? And they say, oh, the ticket's $1,000. My hotel's $300 a night. My flight's $600, whatever. Call it $3,000. And I say, okay, $3,000 to go to this event. And how many days of your life? Oh, it's going to be 1 day. It's going to be 2 days. I'm like, yeah, but you have to travel and okay, it's more like 4 days. Okay. How many calls do you do per day? How many email outreaches do you do per day? Okay, you reach out to 50 people by email, you get 10 responses. I just would literally do the metrics on it. And I'm like, okay, well, if I gave you the $3,000 and you spent that, on, buying, I don't know, 300 leads for $10 each from an SDR, an outsourced SDR, would that be money better spent? And they say yes. And I say, great, let's not go to the event. But if they're going to the event and it's like some legal event and they're making legal services, so just quantify it and be thoughtful. And you shouldn't be, if you're going to go to one of those events and you're a startup, you should be, spending the least amount of money possible, and you should be doing coffees, not lunches and dinners, buy $6 coffees, not $600 dinners. It's be thoughtful about it. Every dollar counts right now, especially in a startup. Jason, would you share a large recent mistake you made in judging an investment and/or team, and why do you think you made this mistake? How long do you have? My Lord. Early in my career, the biggest mistake I would make is I thought I could run a company like that to success, and I could figure out a way to make the company work. And you quickly get humbled in this business because you are not flying the plane. Right? It's not your job to fly the plane. It's that other person's job to fly the plane. So you can only, sit there, and maybe best case scenario, you can be in the cockpit for a little bit of time, helping them navigate or maybe giving them some feedback. But, the founders have to fly the plane. They have to do the work. So that was typically my early mistake. I think my mistake now is, not maybe being too optimistic, about believing in non-builder founders and, getting maybe a little too enthusiastic on the telling of the story. That was probably my second phase of mistakes. First phase was, projecting myself into being the pilot. Second phase of my mistakes was just being optimistic that this incredibly charismatic founder could, do stuff, and not looking at the actual product and product velocity. We never got caught up in FOMA, so I'm proud of that. We saw crazy valuations happening, and we said, hey, do we have the opportunity to sell? And sometimes we did. So, it's really about discipline and, being cutthroat. And you can pass on an investment now and just say, not yet. I really like this idea. You might see a company today. Hey, I really like this idea. I have these two concerns. I encourage you to tell the founder, I have these two concerns, your gross margins, how much you're spending on CAC, whatever it is, your growth rate. Tell them why you're passing very specifically, and then say, hey, and if, maybe we could meet in 6 months or whenever you, if you want, you keep me on your founder update, and maybe we can meet in 6 months when you've got these things dialed in, because that's the time I would feel comfortable investing. And so being really candid, not being a jerk, and giving that feedback is an art. A lot of investors are just like, couldn't get my partners around this, we couldn't get consensus. And sometimes as a firm, we say that we couldn't get consensus, but we like to say after we couldn't get consensus, the reasons why, if we can. And maybe if we sincerely feel like there's a path to making an investment, I think being clear about what that would be. Yeah. If we saw 20% growth for 3 months in a row, or if we saw the current customers landing and expanding by, 20% year over year, like when you get all these renewals going, that'd be a good time for us to take another look at it. And we might have to pay a higher price. We understand that. I like that approach. So we've added that to our game in our second decade of investing. Does Launch help find and match co-founders? In-person conference in the works? Eric, great question. We are doing this at founder.university. Kelly, maybe you could talk a little bit about how we're doing that at Founder University.
Yeah, absolutely. We actually just had a founder this week tell us that she found her co-founder. And we have a few ways. One is just that it is now a pretty large group. As Jason said, it's between 300 and 400 founders. Some of those have fully fleshed out ideas and kind of their first beta users. Some of them really don't have an idea, know the space that they love, know that this is the journey they want to be on, and they are excited to go in and find a team to join. The other thing we're doing is we've got a really strong online community for these folks, so that even though it is a pretty large group, there's a lot of different ways ways that they can actually interact with one another, share their journeys, and again, find ways to pair up. So we're trying to help them out in any way they can. And often that is finding those co-founders.
We basically have a piece of software called Circle that is like a better version of Slack for building communities. And we have people just on a message board essentially there trying to find each other. Is that about, and it's working.
Yeah, it's going well.
It's one of the hardest things you can do as a founder. And if you can't find a co-founder, the way VCs and investors look at that is that you're not qualified to be a founder. So there's some harsh reality to you. This is what investors are saying behind your backs, founders. Oh, they're asking me to find them a co-founder. They can't even find a co-founder. Well, they'll never succeed as an entrepreneur because that's like test number one. What is your thesis on EdTech and education market? I think if you're going direct to consumers, it can be brilliant. We have a company, brilliant.org. And I think if you're trying to go through the schools, it can be a slow slog like healthcare. And it can be a place where LP money goes to die. So I much prefer when people sell directly to parents, and parents will spend any amount of money, even money they don't have, to help their kids with their education. So that's just a general observation I've had. How would you differentiate a seed investment from a Series A investment? I think the way the industry, and where does one end and the other begins, Series A investments tend to be given to two groups of people: $1 million to $3 million in annual run rate of revenue, or a serial group of founders who have had an exit or success before. So getting a Series A, you sold your company for 100 million or 50 million, you took it public, like you can get a Series A immediately. Or it's 3 folks who worked at Twitter or Google or Uber. They worked together, they built a great MVP, they got a couple beta users. They'll be given the benefit of the doubt if it's a really slick product, and somebody might get frisky and give them $3 to $5 million Series A right out of the gate, or a seed round right out of the gate. But for everybody else who's a mere mortal, who has not had a successful exit before, the reality is you have to prove it. And you prove it in a seed round by hitting 10 to 100K a month in revenue, or you're growing your user base by 5 to 10% week over week for a free product. And then for a Series A, you get into low millions of dollars in revenue in today's world. So that's kind of how it goes. Now you do have, sometimes people skip steps. I saw crypto companies raising Series A's on white papers. Bonkers. Any take on what seems to be an increase of venture studios? Yeah, venture studios, there's been BetaWorks, Science, David Freeberg had one for a while. They tend to not work very well because all the economics are captured by the studio. They take 70, 80%, then they hire a CEO and a founding team for 10 or 20%. It's very hard. And then you've got some hired gun CEO. It's not even their idea, so they're mercenary. I think it's a really broken model. I don't recommend it. It's very rare that something great comes out of a venture studio. The cap table kind of needs to be flipped. The founders get 80%, the investors get 20. The venture studios, the investors, they take 80 and they give 20 to the things. It's kind of broken. And then it leads to, when we're investors looking at these, we kind of get jealous and we get cynical. Like, why is Science getting 80%? Why is BetaWorks taking 80%? What, you're asking us to buy 10% and you took 80? There's like a little bit of jealousy between investors. We get a little jealousy. People are jealous of Y Combinator. They invested at an early investment. Why do they get 6% for 150K? Or we get 6% for 100K, they get 7% for 150K. Like, people could even get jealous of that. And it's like, well, do you want to run one of these programs and hire 3 or 4 people to do it? So there's a little back channel on that. Following up on your comments, I'm interested in your thoughts on as to the return multiple expectations for LPs, and have they changed? Anybody who's a seasoned LP understands that you go through super cycles, and we just ended one and we're starting another one, and some group of companies from the last super cycle are going to be just fine and they'll just ride out the storm, and many will get flushed out. And here we go, we're starting the super cycle again. So I think LPs are probably looking at the 2020-21 vintage of venture funds formed as a bad vintage if they deployed capital into that at a high valuation, and they're going to look at these as being a great vintage. So the reason they use the word vintage, like wineries, is like, hey, these were great grapes, and can't make a bad bottle of wine out of these grapes. You have to really screw it up. So if you're investing at companies in 2008 to 2012, when companies were $5 to $10 million valuations. You could buy 10% for $500K or $1 million. Well, that was pretty good time, and that's right now. So the balance, I think this vintage will be quite delicious in 5 to 10 years. Does Founder University enable non-founders to network with founders and pitch themselves as co-founders? Anonymous attendee. That's a great idea. Kelly, I don't know which anonymous attendee had this, but I'm going to take credit for this idea. So let's just pretend I didn't read it. Oh, hey, Kelly. I was just thinking the other night, last night, Kelly.
Yeah.
I had this great idea.
Oh, yeah. What was it?
Well, everybody's looking for a developer co-founder. What if we said, hey, if you're a developer and you want to join an existing startup as a co-founder, we're having a developer matching with co-founders event, and we're looking for 50 developers to meet 50 founders. And we're going to do speed dating. What do you think of this idea?
You are one of the smartest people I've ever met. What a phenomenal idea you just had.
Thank you. Thanks. Say more.
I love it. Let's make that happen.
All right, great. Yeah, just sometimes I have my moments. That's a really good idea. Fuck, why didn't we think of that? All right. I think I've answered like 15, 20 questions. Anybody from my team have any thoughts? Well, I mean, everybody's refusing to leave, Mike.
I think Paul had a question. I don't know. Paul, do you still have that
Yeah,
question?
Paul, hey, my guy, Paul. Paul, you coming to Angel Summit? We got a date.
That was my question. Is there an Angel Summit this year?
Yes, we're going to do it. We had 250 people asked to reserve a ticket if we were going to do it in the fall. And then we got a little worried about fire season. It turned out to be mud season. But yeah, we got a spring date and we're going to do it in the spring.
That's awesome.
Yeah, I'm really excited about it. Mike's very excited to bankrupt the company and buy expensive wine. So
I love that. Thanks.
You save so much money every place else, It allows me my indulgence in wine.
We'll give it back.
First week of May 7th and 9th, we're hoping. We'll let you know.
Great. We'll give it back at the poker table.
Well, yeah, exactly.
The wine money,
poker, right? We're referring to Angel Summit. This will be the 5th one, I think, that we've ever done. I think we've done it 4 times before. Anyway, we're going to do it again, and we'll have 200 people, and it's just only angel investors are allowed to come. And we have a pétanque tournament, which is like French bocce ball. And we rent out a bunch of restaurants. We do activities. We go clay pigeon shooting or wine tours. It's just a lot of fun in Napa and Yountville. And I just got back from Yountville. I went to Bouchon and I had the duck confit. Oh my God, très magnifique. Okay. Any other questions? One more question. Okay. Maybe I answered that one already. Just found yours. Oh yeah, I did that one already. All right, everybody.
I just wanted to say thank you
to
everyone. This is me, Daniel HeyHire.
Oh, hey.
How's it going? Just wanted to thank the whole launch team, Jackie, Andre, Michael, Jason, obviously, and everyone else, and the rest of the founders. This was a great experience. Definitely learned a lot, grew a lot, and highly recommend this for founders who are looking for something to help them grow.
Let's all turn our microphones open and give some snaps.